everybody, this is Bob Iacchino from Pat Trading Partners, along with my co-founder Mike Arnold, and this is technical analysis for cryptocurrencies. Today we're going to cover a technical indicator that we use a lot in our videos. Some of our longer term support and resistance comes from a simple moving average. So let me get started first what moving averages are. So moving averages come in a variety of forms, and the following are various types of moving averages. There is the simple moving average, the exponential moving average, the weighted moving average, the adaptive moving average, the displaced moving average. So in this module, we're going to talk about simple moving averages. The simplest form of moving average is appropriately named the simple moving average. You'll hear people refer to it as the SMA. There's also a smooth moving average, but when somebody talks about the SMA, they're usually referring to the simple moving average. A simple moving average is calculated by computing the average price of the market over a specific number of periods. So the formula is simple moving average equals price 1 plus price 2 plus price 3 plus whatever plus price X, whatever X periods that you're using, divided by that number of periods. The price could be the open, the high, the low, the close, or even the average of the high and the low, or the high, low, and close. When calculating the moving average, the duration of the average needs to be defined. So let's assume we're calculating the average based on the closing price. We then need to determine the length of the average we are calculating. So this can be any number greater than 1. For example, if we're calculating a 10-period moving average, then we are taking the closing price of the last 10 days, adding them together, and dividing by 10. It's pretty simple stuff. The period represents the duration of the bar or candle on the chart which the moving average is calculated. For example, if the average is plotted on a daily chart, then it would be using the daily closing price. If it's on a 60-minute chart, then it would be using the 60-minute bar's closing price. It's a common mistake, actually. People will say, I have the 10-day moving average on the hourly chart. Unless you preset it that way, it most likely isn't that. It's the 10-period moving average on the hourly chart. In other words, 10 hourly closes or 10 hourly highs or whatever input you're using. Let me go ahead and turn it over to Mike to talk a little bit more about the calculations.
So let's take a look at the simple moving average calculation. Now we're going to do this by looking at the simple moving average calculation of a daily closing price. So on the right-hand side, you see the daily closing price, and you need at least 10 inputs before you can calculate this. Otherwise, you couldn't take the average of 10 periods. So what we do is we add 50.95, 51.68, 50.91, etc., all the way down to 48.33, and then divide it by 10, which gives us our first SMA calculation, which would be 48.48. Now, when you want to calculate the next one, the easiest way to do it is take that 48.48, multiply it by 10. That gives you your old sum. Subtract the first data point that's going to fall off, because as you move forward, the old data points are going to fall off. So 50.95 would fall off, so you'd subtract it, and you'd add in the next data point, which would be 46.32, and then again you divide it by 10. So that would give your new moving average of 48.02. The simple moving average is one of the most popular among traders and investors. Historically, it was one of the most utilized technical indicators due to simplicity of the calculation. I mean, you can calculate with a simple calculator. You could calculate on the paper if you really needed to. It's a very easy calculation. One of the criticisms is that the SMA gives the same weighting to each data point. Well, how do you solve that? We will investigate the exponential moving averages in another video, which reacts more quickly to recent data, and we'll get all into that when we cover the exponential moving average. But for now, we're just looking at the simple moving average. So some of the common uses of SMAs. There are 4 major categories most traders use moving averages for: defining trends, support and resistance, trade entries and triggers, and trade stops and exits. So in this video, we're going to investigate the first 2 items in the video and then the final 2 in the exponential moving average video. So we're sort of dividing it up, but either the simple or the exponential can be used for all these different categories. just covering 2 in this video and 2 in the next video. Let's look at the simple moving average of defining a trend. So some traders use moving averages to reduce market noise and help define a trend. Moving averages that are sloping up can be interpreted as a market being in an uptrend. Moving averages that are sloping down can be interpreted as a market being in a downtrend. Moving averages that have flattened can be interpreted as a market entering into consolidation or switching directions. Let's take a look at a graph for this. So here, this is happens to be Bitcoin versus the US dollar. You could use Bitcoin, any cryptocurrency. You can use a foreign exchange currency, the pound versus dollar. You could use the S&P 500. You could use anything you want, a stock. It doesn't really matter. We're just happen to show this on a cryptocurrency. So it's starting to trend. The market's trending up, which means it's making higher highs and higher lows overall. And you can see the moving averages sort of go from flat to, we have an 8 in orange, which slopes up first. Then the 21 period is blue. And then the 50 period is green. And they all start sloping up and sort of getting farther apart. Then you see how it goes in consolidation at the top, and they all start coming together again. So it hasn't really changed direction yet. This would be a consolidation. And before that, at the bottom here, you can see it's in a consolidation. Then it does what we call in technical analysis, breaks out of the consolidation, and the moving averages start to rise and define the trend. So they're sloping up. And when they're flat, it's a trendless market. And then if they were sloping down, it would be a downtrend. So you see over here on the right-hand side, the blue starts sloping down. It could mean the trend might be changing, but it's still within this defined range, so it hasn't really changed yet. Let's look at the concept of the simple moving average as support and resistance. So the moving averages are also used by a lot of traders as support and resistance. Many traders look to key moving averages as areas in which the market will either find support or find resistance. Some of the key moving averages that are utilized are the 10, 20, 50, 100, and 200 period moving averages. Notice again, we did not say day moving average because this could be on a 5-minute chart. It could be on a weekly chart. It could be on a 4-hour chart. But those are the most common periods of moving averages, and in some ways they become a self-fulfilling prophecy. The more people that watch them, the more people that watch them for potential support or resistance, the more people react to them at levels. Let's take a look. On this chart, this is a Litecoin versus the US dollar. This is a 200 period simple moving average. Many traders look at a 200 simple moving average. And this is on a 15-minute chart. So you see it comes down, finds some support over here all the way on the left-hand side, breaks through, then finds resistance, resistance, resistance. So these would be maybe areas that traders are looking to sell it. Continues lower. Comes back up, first time it hits it again, finds resistance, comes back through, finds a little resistance, and breaks through. Now comes down, finds support. One of the concepts that you'll hear many times in technical analysis is prior support becoming resistance and prior resistance becoming support. Whether that's just with the price action on the charts or with the concept we're looking at now, the moving average. So then you see it move back up, then it comes back down, finds some initial support, then breaks through. Resistance, resistance, resistance. Moves back all the way down, comes back up, spikes through, resistance, resistance, and then moves back down. So you can see how throughout this period of this chart, there are many times that traders might have looked to buy or sell, depending on their viewpoint, against the support and resistance. Here's another area where you can use more than one moving average, and we use something called a rotation zone, which is some key moving averages to look for key areas to either buy or sell. So as it starts breaking down from this consolidation, the moving averages start moving apart. You can see that between these two averages could be selling points. So it comes up here, sells down, returns between the two moving averages, moves lower, returns between the two moving averages, heads lower, does not get below the last low, gets back above it, then it becomes support between those moving averages. Breaks back down, then it's resistance between those moving averages for 1, 2, 3 more times as it continues lower. So you don't just have to use one moving average, you can use moving averages in conjunction with each other, which would be a moving average zone, to find key areas where it could continue a trend or potentially reverse a trend. Turning it back over to Bob to go over some simple moving average tips.
Thanks, Mike. So shorter length moving averages will turn faster and will change direction more often. So in other words, if you're using, say, an 8-period smooth moving average and a 50-period smooth, obviously the shorter time frames, the more important each input is in terms of determining where the next level of the SMA falls. So shorter length moving averages will turn direction and switch and seem a lot more choppy than the longer length ones. That means the number of inputs. A good SMA length to use for identifying the trend is the 50-period SMA. If you watch any financial shows, I know a lot of crypto guys are kind of anti-finance, but if you ever watch any financial news, you'll hear some of these traders on TV say, well, we're near the 50-day moving average. 50 is a very common one, and it's just a good trend identifying length for cryptos as well as traditional markets. Many times, moving averages become a self-fulfilling prophecy for support and resistance, so knowing the most commonly watched moving averages generally the best for this purpose. Moving averages define areas of support and resistance, as Mike said, zones, and should not be treated as brick walls. You want to more watch price action around the moving average than immediately enter a sell order when it gets up to one that's above your price action, or a buy order when price goes down to a moving average that's below the current price action. And do not fall into the trap of over-optimizing the moving average lengths to best fit the market during a specific period of time. You may see a time where you've got the 50-period simple moving average on your chart and you notice it's falling short of it, so you adjust it to the 48 and you're now like, wow, the 48 works much, much better. Then it starts blowing through and you adjust it to the 52 and you're like, well, now the 52 works much, much better, so I'm gonna leave that on. Don't fall into that trap. I'll cover some of the most common ones in the conclusion, which is right now. Moving averages can be a very useful indicator for many traders, and that's what you guys are. If you're not just buy and hold crypto currency investors, you're trading cryptos. You are now a trader. They are one of the most utilized indicator, and many traders and institutions have moving averages on their charts. That is part of the self-fulfilling thing that I just mentioned. If you're investigating moving averages to incorporate into your trading, as I mentioned in the last slide, start with looking at the most commonly used lengths like the 10, 20, 50, 100, and 200 period moving averages. These are the ones that most people will have on their chart, and then that sort of adds a little bit of oomph or a little bit of strength to that self-fulfilling prophecy part of the moving averages. If you want to know anything more, follow us on Twitter, and you can go ahead and ask us questions there, and like us on Facebook. Visit us at pathtradingpartners.com and go ahead to our website and sign up for all our free webinars. We've also got a podcast. There's a bunch of episodes. We've got high double-digit episodes of the podcast right now. You can find that on our website as well, and check out our blog articles, which can also be found. And check out our blog articles, which can also be found on the Path Trading Partners website. Thanks for watching, guys, and we will talk to you in the next video.